Hey guys, welcome back to episode 11 of the We Talk Money Show. I'm Chris Dunn, your host. I'm here with Nikki, certified financial planner, and Travis, hedge fund investor pro. And listen, let's just jump right into it, guys. Things just every week keep getting more and more intense. So what I want to do is jump straight into the lessons. Yesterday, we did a live webinar. We had about 1,000 of you guys join us where we talked about different strategies for how to invest in a recession if we go into a full-blown recession or worse, and also looked at a couple other possibilities, because the reality is we don't know what's going to happen, right? We can only think like chess players and poker players, where you look at your competitor and all the moves that are available, and then based on probabilities and possibilities, decide what you're going to do. So what do you guys think? What's on your minds today?
Another wild day.
Yeah, it's nuts out there.
Yeah, it's we're seeing the whipsaw of huge up days and huge down days, and honestly, it's pretty textbook. This is a classic pattern that we see in really volatile bear markets. You see, typically very, very large moves in both directions, and that's why when we look back at the data on the markets historically, we see the best down days and the best up days tend to cluster together, and they're during those periods of irrational fear and panic. And so that's exactly what we're seeing now. We're seeing, like yesterday, we had a big bounce in the market. Today, another big down day.
Yep.
I know who's happy. The futures traders.
Yes. Yeah.
The volatility is finally back for them.
Absolutely. It's been almost, 8 years of just really slow, grindy bull market action. And so let's just talk about where we are and what's happening, because I know a lot of people are freaking out right now. And the big question is, A, what is happening, and B, what do we do, right? So hopefully in today's episode, we can answer that at some level for you guys. Before we do, so let's do this. What we're going to do, this is kind of a special episode. We're going to do kind of a recap of what we talked about yesterday in the live masterclass, and also kind of apply that to what the markets are doing right now, because every day something new is happening. And, we've got coronavirus that officially, as of a couple hours ago, the WHO came out and officially labeled it a full-blown pandemic. On one side, you've got people that are saying that this is the end of the world. On the other, you have people calling it a hoax. We're not going to get political in the show. Our goal is to approach the markets and approach everything with the hat of professional investors. All right, we want to look at this and figure out, how do we navigate these turbulent times, and how do you protect your downside and manage risk and position yourself to profit, right? So just kind of taking a look at the screen here, our approach, we are not here to sell fear or conspiracy theories, right? Like, we're not out there, thumping the idea and the narrative of the world is going to hell, the financial markets are completely over, and everybody's going to die.
The sky is falling.
Right?
We've been here before, believe it or not. I mean, we've been here before, just different crises along the way.
Yeah. And granted, this, the pandemic and the virus, I feel like, is not something to take lightly, but we do need to differentiate between real risk, AKA danger, and irrational fear, which can lead to panic, right? So with that said, let's just talk about, like, in times of panic, right? Like right now, we are in a time of panic. We've had that initial shockwave where you get the initial kind of that first wave of selling, and then you get a little bit of a capitulation, and then that's usually followed by like several months of volatility, right? And I tweeted this the other day. I said, there are a few times in a lifetime when the markets get shaken up in a way that creates big winners and losers in the short term, and then offers opportunity for people to position themselves for massive growth over the long term. And this is the start of one of those periods. Is this the bottom of the market? I don't know. We can discuss that. Are things about to go into a downhill spiral that's just uncontrolled? We can talk about that as well. But let's just talk briefly before we jump into the charts and actually what's happening about the mindset that we want to take here. We've got a couple of quotes. Whenever you find yourself on the side of the majority, it's time to pause and reflect. And that goes for both sides, right? Like when everybody is fearful and like, I love these pictures of the old school Wall Street traders, head in hand. Oh my God, I can't believe the markets are tanking so hard. Or on the other side, euphoria. What kind of mindset are you guys approaching the markets with right now?
Honestly, I have talked about this many times. I we've always been saying that if this type of event happens, we know how to approach it as an opportunistic situation. And I think that's how we're both, keeping that in our mind is, this is one of those chances, like your tweet. This is one of those chances that if you position yourself correctly, you could pick up companies that you've been wanting to own, but they've been too overpriced. You can set yourself up to truly generate long-term wealth in the future. 2008 was one of those moments. It appears we're approaching a similar situation. December 18 was a similar situation when we had that almost 20% sell-off. That kind of caught people off guard a little bit.
Yeah.
And this has happened very quickly. But I think that I'm approaching it as I'm thinking long-term, I'm thinking opportunity.
Yeah, cool-headed rationality. It's easier said than done in an environment like this. When you start to think about what the potential implications could be when, things are happening in the real economy, people are actually, losing jobs. Here in Austin, we had South by Southwest canceled. And so a lot of the service industry people were hurting. And so there's real impacts. And so it's hard to keep an investor-only mindset and a cool, rational perspective when all that's going on. But if you position yourself the right way and you're not overextended, you're not leveraged, then, and you have dry powder in the portfolio, hopefully, then you've got the ability to approach it with a more rational mind.
Absolutely.
Yeah, and to speak to that, it's almost like you have to take two hats. You have to have the, I care about obviously you don't want this to occur to you or for your family to catch the virus, where we know that this affects the elderly differently, so we want to be very mindful of that and take care of our family and parents. But then you have to have the investor hat too, right? Where you don't want all of this carnage to be going on the emotional side and like the humanity side, but there's this opportunity on the wealth building side that you kind of have to wear two hats. And
that's a good point. That's a good point. And that actually, I think, can help answer the big question that everybody has, right? Is what are the markets going to do? And there's really two approaches you can take. What I consider the wrong approach is trying to guess what's going to happen and then like putting it all on red. Like in the crypto space specifically, I see a lot of people right now going, oh, this is it. Financial system is about to collapse. We're about to have a reset. The stocks are over. Like they come up with these very extreme examples. And sure, that could happen. It's a low probability, right? But something like that could happen. The right approach, I feel like, is creating a plan for each possible outcome so you can potentially profit and manage risk no matter what happens, right? Like a lot of newer traders I see in the markets, they try to approach it with a I know what's going to happen mindset. Shit, we're both a couple decades into this, and I feel like the smartest people in the markets approach it with I don't know what's going to happen. I know the possibilities. I know what could happen, but ultimately I don't know what's going to play out. So let me position my chips in a way where I can win no matter what.
Yep, That's right.
And the one thing the market hates the most is unknown, right? The unknown. The market hates that. So you have to know that and understand what you're getting into here. The market has no idea what's really truly going to happen, how this virus is actually going to affect company earnings. Yeah. We know it's going to affect company earnings, but to what degree, we have no clue. Even the companies don't know.
Yeah, we've seen a number of big companies just pulling their guidance for the year. This week, actually, we saw Booking Holdings do that. We saw a few others as well.
There was an airline, I think, I think it was...
it might have been Southwest or Delta or both. I think most of the airlines are now probably pulling their guidance for the year, obviously. So... and that's just them saying, look, we don't know yet. It's too early to like put out numbers that are going to tell you what we're going to earn this year.
Yeah. And I've been keeping a very close eye on the new virus numbers and the deaths and just looking at how different countries are handling this, right? Like on one side, you've got what South Korea is doing where they're managing it beautifully. I mean, they've got their new cases, like they're just collapsing, right?
They bent the curve, so to speak, bending the curve.
Bend the curve. Yeah, exactly. And then you've got places like Italy that just a couple weeks ago were laughing this off as it's just the flu. Yeah. And now their hospitals, it's devastating what's happening in Italy. I mean, set aside that the whole country is on lockdown, their hospitals are at 200+% capacity. Yeah. So they're literally triaging at the door. Who are we going to help and who do we just have to push to the side and let die?
Yeah.
And as of today, they were at a new all-time high of daily deaths and new cases.
Yeah.
So that is an example of what goes wrong when you don't take it seriously.
Yep.
In the U.S., man, I don't know. I mean, we've got, a lot of tech companies are pulling their employees home, doing social distancing, but then you've got areas around the country that just are not taking the testing seriously. So I don't know.
Yeah.
You guys have any thoughts on that or predictions or?
We're going to see the trend continue. We're going to see more cases exponentially.
Yeah.
As far as when the curve will bend or when, we'll finally start to kind of get over that hump and see declining of new cases. I mean, we're going to have to take action. Something's going to have to happen to stop the spread of the disease.
Yeah,
of the virus.
I think once a very famous person, a politician or somebody just very well known gets really sick with it, I think that'll wake people up that aren't taking it seriously.
Yeah.
Yeah, and there's this kind of debate right now between people that are young and then people that are young are kind of brushing it off like, oh, I'll be fine.
Yeah.
Really, the concern is overwhelming the hospitals and our elderly,
yeah,
our parents and our grandparents.
Yeah, and there's two things, right? So aside from the virus, people are like, oh, well, the death rate is super low, right? Well, here's the problem. Like, to your point, if the medical system gets overloaded, it collapses. Say you get in a car accident or you have a heart attack or something like that, and the hospitals are overloaded, you can't get help. Right. So forget the fact that whatever the death rate is, if the hospitals are over capacity, you're screwed. Also, on the other kind of social side, which we're already starting to see a little bit of this locally and in different parts of the country, people freaking out and making irrational fear-based decisions. It's kind of funny to talk about, but not really, people running and buying up all the teepee, right?
I saw the Target CEO, I think it was, made a comment about this, that trend, it was something about the trend of hoarding is continuing. And they're kind of seeing it as like a positive for the company. I mean, I think if I was reading it right,
I think the problem with that is like companies like Costco and Target are obviously seeing a big sales bump. We saw that in the Costco numbers released, I believe, late last week, or maybe it was early this week. But then that is actually going to, at some point, if this thing does pass, then 6 months, 12 months from now, they're going to be looking at comparable sales declines because people stocked up and now they've got a stock that they've got to work through. And so they won't be shopping as much on the back end. So, it sort of works itself out. But it's good. Yeah. I have seen comments now that they're starting to finally, a lot of these stores are finally starting to put limits on how much people can buy. So hopefully that'll shut off some of that irrational buying.
Yeah. Well, so that's kind of the recap on what's happening right now with the virus. This was actually the front page of the Wall Street Journal yesterday. Dow plunges 7.8%, suffering the worst drop since 2008. Oil prices post biggest slide since the Gulf War in 91. Yield on the 30-year bond falls below 1% for the first time. Man.
Yields bonds have been lit.
Yeah.
Quite the headlines.
Yeah. I mean, so anytime there's this level of emotion in the markets, there's opportunity, right?
Yeah.
So let's talk about that. Why don't we just kind of fast forward? Obviously some other things going on. We've got the Saudi-Russia oil price war. Trav, you want to kind of touch on that? What's going on?
Yeah, I think that was sort of almost like a second black swan that got layered on top of everything else that was going on. Oil demand was going down with people, with less economic activity happening because of the quarantines. And so what should have happened is the oil producers should have cut supply. But when OPEC and Russia met, Russia was like, no, we're not going to cut supply. And then the Saudis over the weekend also said, well, all right, if you're not going to cut supply, we're not going to cut supply, and we'll show you what an oil price war looks like. And so oil prices had a historic collapse on Monday, and that led to one of the biggest down days we've had since the financial crisis. Some of the energy companies in the U.S. were down like 50% or more in some cases.
Wow.
Even a lot of the pipeline companies and infrastructure companies related to oil and gas, absolutely decimated.
Yeah.
So since the beginning of the year, oil's basically cut in half, right? It was up around 60, 65 bucks. And then we're flirting with the high 20s right now, currently sitting around 32, but had the big gap down on Sunday, little bit of a bounce. But if we zoom way out on this chart, you can see, I mean, there is an established range going back in the 80s and 90s around, 10 to like 30 bucks. So, I don't know. What do you think? Could we get stuck there for a while?
Yeah, we could, because the big producers like the Saudis and others can keep producing at they have relatively low cost to produce, and most U.S. producers don't have free cash flow or don't generate positive earnings at $30 barrel oil. They do have hedges that will last, or most of them have hedges that will last them through the end of this year and maybe early next year. But once those roll off, they're in trouble from a financial perspective. And it doesn't just affect the energy market, because there can be spillover. There are banks that hold the debt for a lot of these energy companies, banks that lent to these companies. There are people that work for these companies that may have layoffs. So we may see contagion effect from an energy sector that, is really unhealthy.
Interesting.
So it's a problem. It's a real problem.
Yeah.
Layers upon layers of crap right now, basically leading to this environment.
So that leads us to the next segment, which is called What the Hell Do You Do? So what is the wise plan of action now? I'm sure you guys are ready to get to that. Again, with the idea that we can't predict the future, we can only create a thesis or a hypothesis around the information that we have today. What's the wise plan of action? Well, I think we should come up with a few. Mm-hmm. The first one being, well, what if we go into a recession, something like 2008, or worse? What if we do the D word? What if we go into a depression, right? What if we have a recession that leads to either some really nasty stuff or even a depression like 2008 or worse? Or kind of the second option, what if we just see a quick recovery? 1987, we had some pretty scary times, but that only lasted a few months, right? We had a few months of panic, and then the
market was down, about 30-35% within a few months in 87?
Yeah. Let's take a look at the chart. So basically, it took a little bit of time to get back to a new all-time high. Right through here, we had basically 3 months of selling, and then basically a V-bottom, double bottom bounce, and then it was at a new high within a year or two. Yeah. So that's kind of scenario number 2. And then scenario 3 would be something more like what we saw in the late 60s to the 70s, where we basically just chopped sideways for a while. So if we take a look at that chart, you can see what happened here was in the late 60s, we started to make higher highs and lower lows. So higher highs, lower lows. So this was just a really, really volatile time. The market had a 50% sell-off in 73. We had, interest rates that were going crazy. It took quite a bit of time to make a new all-time high. So that's another possibility that I just want people to kind of entertain, is the idea. Like, yeah, we could have low drawdowns. We could even make a new higher high, but then maybe we do some kind of like mean reverting action for several years.
I think this is important to do, to go back and actually look at prior crashes and prior bear markets to kind of help put things into perspective. I mean, you can see that history is repeating itself right now. We've been here before in terms of we've had these, catastrophic things happen in the past. We've seen our markets sell off, 50%. And look what happens every single time. Every single time it's like we forget, and it comes back, and then we all forget about it, and then the next crisis happens, and here we are panicking again. What do we do? Like, guys, we know we've this has happened before, and in the moment, it's easy to forget that.
Yeah,
because it's so emotional. It really is.
Yeah, and I think we mentioned this last week, but the idea that it has been over 10 years since the global financial crisis, right? Yep. There's a whole new generation of people that have not lived through a bear market before.
Absolutely.
So I feel like it's easier to buy the narrative that everything's going to die or that the financial system's going to collapse. I mean, I found myself in 2008 questioning it and going, man, this looks bleak. Like, how do you possibly get out of that?
Yeah.
Right. But it's when things look the worst that's maybe when you're close to a bottom, right? Mm-hmm. Now we could have some like end of the world scenario, but I'm bullish on humanity, right? And I'm not going to put my eggs in that basket. I'm going to hedge. I'm going to own Bitcoin. I'm going to own gold. I'm going to own physical assets and a lot of the things we can talk about in a minute. But at the end of the day, I think it's just wise to kind of take a step back from the news. I don't care if you're liberal or conservative or if you're somewhere in the middle. Step back, be an outside observer, right? Like, don't get caught up with the herd and look at all the possibilities and say, why could my own beliefs be wrong?
Yeah.
Right. Like, it takes courage to do that.
Yeah.
Not a lot of people want to question their own thought processes.
Yeah.
And I call them angry drivers, like people that are on social media, screw you, man. You know what you're talking about? Like, okay, people that get the most heated about it are usually backing themselves into a corner and missing the forest through the trees.
Yeah.
So with that said, Trav, what do we do if we do go into a scenario number one, like a recession?
Yeah, it's a good question. So, I mean, I think there's, a few things we can do in that type of environment. And it's important to understand too, like the difference between, an actual economic recession and what the stock market does. The stock market is forward looking. And so that's why you'll see like what we had in 2009, the market actually bottomed in early 2009, even though unemployment rates didn't start actually going down until like 2010, 2011. So you also kind of have to make sure you separate those two things in your mind as an investor.
What that a recession is different than stock market moves.
That's right. Yeah, the stock market will lead. So, if you're trying to wait for the skies to clear and things to look, totally rosy again, you'll have missed probably the market doubling potentially, right? Or some of your stocks doubling. So, so it's important that we, be rational and make sure that we protect our portfolios and not do anything totally stupid where we're going to blow up during a recession. But we've also got to position ourselves to think about how might we actually make money during and after the recession. So that's kind of how I think about it. So for going into a recession, there's a couple things I like to do. One, I like to have dry powder and cash in the portfolio. And I also sometimes like to have hedges on. Like this is a perfect environment or a perfect example of an environment where we're doing things that really rhyme with other things we've seen in these market environments where we get these sharp corrections, sharp bounce, sharp corrections, sharp bounce. And so you can sometimes use that to your advantage. If you understand that we've moved into a new market environment, you can do things like, short index futures like I did back, on March 2nd. I alerted our investor community that I was actually putting some hedges on. So
what does that mean? Just kind of at a high level, basis. What is hedging and why would somebody want to do that? And what does that do for you? What's the net benefit?
Yeah. And there are different ways to hedge, but a hedge generally is a way to kind of offset the risk that you have in your portfolio. So if you're long the market or long a bunch of stocks, you can offset that risk that those things will go down in a down market environment by actually being short the market or short certain stocks. And that allows you to actually make gains as the market or those stocks go down. So shorting means you actually sell the share, you borrow the shares from your broker, you sell them in the market, and then you hope to buy them back later at a lower price, which gives you a net gain.
Yeah. And so, one thing, when it comes to that, there's really two options, right? You can either do it yourself or have a fund or a professional trading company basically do that for you. Like with managed futures, we talk about that. There's several funds out there that you can invest in and they'll basically do all the work for you. Or like you did, you can place that yourself and self-manage that.
Yeah, that's right. Yeah. So, my thinking there with adding some hedges when the market was bouncing on one of those big bounces in early March was I still think there's potential for another 20-30% downside in the market. I do like the stocks in my portfolio, and if they get cheaper, I'll buy more. But from the general market perspective, I don't want to take a lot of broad stock market risk. And I think there's potentially further downside. And so I shorted those index futures, which allowed me to have gains if the market did go down further, but it also gave me some extra cash to have in the portfolio that I could use to add to my positions.
Awesome.
Now you do have margin requirements that you have to maintain in your account, but the hedging actually does help offset some of the risk you have, some of the broad market risk you have with owning stocks.
So that's a good strategy for going into a recession, right? Yeah. Once the recovery starts, you're kind of on the wrong side of that, right?
Yeah, I mean, if the market's down 40 or 50%, the odds are you probably don't want to be heavily short the market at that point. Yeah. We just don't have that many instances in history where the market was down more than 50%, right? So you don't want to be heavily shorting at the bottom.
So have cash, hedge with futures. What else should we be looking for going into a recession?
Well, you mentioned it earlier, but other assets that are less correlated to stocks like gold, Bitcoin, and we've seen those assets perform differently than stocks do, both in and coming out of the recession.
Yeah, and that's one thing. So like talking about gold, right? Gold had during the GFC in '08, gold sold off about 35% before ripping to new highs. So it's talking about this kind of initial shockwave that we're in, because we are noticing a lot of assets selling off, right? Yeah. Gold has been hanging on, but barely. Bitcoin's down. Obviously, stocks are down. Bonds are really the only thing that's up. And so one thing that's interesting about Bitcoin is it was born in the dust of the financial crisis, right? So it truly hasn't lived through a full recession. So we really don't know how it's going to behave. I'm bullish on it long term, but I do think it's susceptible in the short term to those shock moments, right? Where when people liquidate everything, they're probably going to sell some Bitcoin too, to be able to live, to support their lifestyle, right? And to buy food and pay their mortgage or whatever. But one thing is really interesting is we do have the halving coming up in about 2 months. So we'll see. It's right now is a very, very interesting time, and just kind of keeping our eye closely on Bitcoin's price right now.
Absolutely. Yeah. And then one other thing that I want to make sure we chat quickly about here is owning quality stocks at bargain prices. So going into a recession, this is the time when you're often able to actually increase the quality of your portfolio. Nikki said it earlier, being able to finally add quality companies with, good management teams, good long-term prospects, conservative balance sheets at reasonable prices. We haven't seen those in a couple of years on those kinds of businesses. That's been the biggest
issue.
Yeah. So
everything's been overvalued and expensive.
Now we have the chance to up-level the quality in our portfolio, and it's very important to focus on quality going into a recession. What worked before this environment may not work exactly, going into or out of the recession. So I'm making sure that, we are adding stuff that's going to survive a recession, number one, and, stuff that will actually thrive once we come out as well.
Yeah, that's the biggest. Yeah, that's
so don't go into stuff that's has too much debt.
SBC, Tesla and SBC.
So let me ask you this. Let me ask you this, because talking about quality stocks at bargain prices, I'm sure there's somebody out there that's going, well, which stocks at bargain price? Which ones? So let me just ask, I guess broadly, what is either a market sector, or if you have specific stocks, but where do you see the sector that has the biggest room for a pullback, or that you're most excited about buying at cheaper prices?
The sector or specific stocks?
Either or, whichever one you want to look at. Where have you had frustration because in the past they've been overvalued and you're like, man, I love this company, but I'm not buying at this valuation?
Obviously tech, that's a big one. Yeah. Like for an example, right now I'm watching Facebook. Okay. Mm-hmm. Facebook is one that, it got a little overheated and
yeah, we can pull
it's one that I would love to own cheaper at a cheaper valuation. Yeah.
Man, you guys remember how much people were hating on Facebook back here when it was like,
I know,
$20.
Look at it now. There's things like Square, some people, obviously that one has been a high flyer historically, and it's been trading at a higher valuation. But if that came down significantly, the tech sector for me, I think getting more into
and just taking a look at the NASDAQ, right, which tracks a lot of the tech, you can see, this has been up huge. This tends to be the most volatile index, I think. If we look back at, the dot-com bubble in 2000, this thing was down 80%. So do you guys foresee, asking about predictions or just ideas, I kind of ran this on the chart the other day, looking at what this would look like if it fell by 50%. And then that actually kind of meets up with the prior top from the dot-com bubble. What do you guys make of that?
Yeah, I actually think tech is still pretty expensive, on average. I still see a lot of, the high-flying tech names still trading at pretty hefty valuations. I still think there is definitely potential for more downside. Now, these businesses are the faster-growing businesses in the economy right now. But the valuation multiples had expanded so dramatically over the last 6 to 12 months that there's still a lot of room for those valuation multiples to compress. And especially if those companies start seeing their growth rates crater during a potential recession, then you've got a potential decline in earnings and the earnings multiple. So it can be a pretty bad double whammy for some of those tech stocks. So yeah, I think generally, potentially, definitely, some opportunity for more downside in tech on average. But
So you don't think now is the time to YOLO dip buy Tesla?
no,
I'm
I don't.
surprised it's not down more, to be honest.
Yeah, and that's the other thing is I think people are still, we're down 20% from the high, but I still see a lot of people out there very excited about buying dips, holding on to their high flyer stocks. Like, I don't think we're necessarily going to bottom until a lot of those people start, panic selling and just sort of in that despair phase.
Yeah. Yeah. It's kind of like we're just getting to the point of like, oh no, things are still okay, but we haven't hit despair. We haven't hit the point where people are like throwing in the towel. And usually that's when things turn around, right? When all hope is lost.
Yeah.
You're right. I did see someone on my Facebook feed, just like a friend, that was like, just bought Apple. It was a comment. It wasn't even a post. It was like, just bought some Apple and some Facebook and some, he was talking about all the stocks he bought on sale.
Yeah.
So yeah, I have seen actually a few people on my Facebook feed saying that, which is interesting.
I guess it's nice to see some people looking at this as an opportunity and not like totally just selling out of everything.
Yeah.
Panicking out.
But I still think there's a lot of complacency, especially with these like buyers of tech names over the last year, like thinking that they're adding at good prices with those stocks only down like 10 or 15%. Like, no, I'm sorry. Some of those stocks still have like 50% downside. We'll see.
Yeah. I mean, it'll be interesting to revisit this in a couple months, and we're either going to be right about tech or it's going to be like, no, things still are overheated.
Yeah. And there's on the flip side of that, there are sectors that have been absolutely decimated where I think there is starting to be some pretty tremendous values if you can look forward 2-3 years out. Then that's the obvious stuff like anything travel related, energy, retail. Some of those companies are not going to make it out of a potential recession if we end up there. But the ones that do, that are being priced at 3 times normalized cash flow could be multi-baggers coming out.
Nice.
So
cool. So, okay. So those are some strategies going into a recession, right? And Trav, I wanted to kind of bring this up because you were working in the hedge fund space during the '08 financial crisis, and you guys did exceptionally well. Why don't you kind of explain the thought process and the story behind what happened there?
Yeah. So we had, it was a really fantastic and interesting time. I mean, very scary time, obviously, in 2008. But when, we had our best year ever at the fund in 2009. And actually, a couple years after that, even, I think 2010 through 2012, we were consistently putting up massive returns. We were listed in Barron's as one of the top 100 global hedge funds, year after year because of the returns we were putting up. But a lot of that came from actually doing the work and buying positions at the depths of the crisis in late '08, early '09, mid 2009. So we didn't wait again for skies to clear. We were doing the work, trying to sift through, what was going to make it, what looked insanely cheap, what had really interesting assets for longer term positions. And so that's what really set us up to outperform over the next 5 years.
So it's the moves that you make going into a recession that set you up for having your biggest years.
Yep.
And we're not talking about small amounts of money. I mean, we're talking about hundreds of millions of dollars, right? So to be able to place that kind of capital in the markets during those elevated levels of fear, like that's something to commend because not a lot of people can do that.
Yeah.
So in the words of Rocky, you guys were buying degenerate red candles.
Yes. Okay. Crypto hustle. That's for you, buddy.
We definitely caught some falling knives, and look, we didn't catch the bottoms on a lot of those. We were buying early, and
you had some drawdowns, I'm sure.
For sure. Yeah. 2008 was our only down year at the fund. But by 2009, because of that banner year we had in 2009, we well achieved, our watermark or our break even. So the gains that we had in 2009 way more than offset the small amount of losses we had in '08. So
awesome. So let's talk about strategies for coming out of a recession. What do these look like?
Well, so that's a really important point because we have to think about as investors, again, what does the future look like? If you're constantly looking in the past, then you're going to be behind the curve and you're going to miss the big returns. Excuse me. So I'm already starting to think about what does it look like if we do go in a recession and what is it going to look like once we start coming out? What do you want to own and how can you position yourself? So, look, we're already seeing monetary and fiscal responses. The federal governments and central banks are going to do everything they can to try to make sure that we don't end up in a capital D depression.
Yeah.
So we're already seeing talks of payroll tax cuts, lowering interest rates, fiscal spending. South Korea put out a 10 billion spending package. China's been putting out stimulus packages. So we are going to see a big response on both fiscal and monetary policy side. So I'm thinking about, although we're in crazy low interest rate environment, are we going to potentially be looking for a reflation trade or, higher growth and higher interest rates coming out of this thing? Because there's all this money that's being put into all these different areas. And once things stabilize, we could really be a rocket ship coming out the other side. The Fed has talked about a 2% long-term inflation target, and, they haven't necessarily been able to hit it. But if you're buying 30-year or even 10-year bonds at, less than 1% interest rates, you're going to expect to lose money or your purchasing power to inflation if the Fed starts hitting that 2% inflation target. So that's kind of what I'm thinking about. How do we benefit from, higher inflation a couple years down the line, or what we call reflation? And what assets benefit from that? What assets might benefit from the fiscal spending?
So that's if we have like kind of a V bottom bounce where economic activity coming out of this is still strong, picks back up, interest rates start to climb again.
Yeah.
Right. What's the opposite side of that? Right. So that's a good argument. And I love how pragmatic you are, and you can look at both sides and kind of empathize with the perma bears and the guys that are super bullish. Like, what's the other side of that argument? Why might that not work?
Well, yeah, I mean, and it could be like what we saw, like you show with this like 60s, 70s time frame, where what they're doing just isn't sticking. The economy just is stuck in the mud, or we end up in some stagflation type of environment somehow. So there are definitely scenarios where that could potentially happen, where the fiscal spending isn't done in the right way, or or it's just not getting the actual economic activity to move the way they want it to.
So it's like they're trying to inject as much as they can, and it's just not working.
Yeah.
That could happen.
Yeah. So that is certainly possible, but again, these are large bazookas of money that they're trying to aim at this problem.
Yeah.
And in the short term, again, I don't know if that doesn't fix the coronavirus problem. So we may not see the effects of that right away. But might we see those effects, 6, 12, 18, 24 months out? So yeah, and a couple of those things, also benefit what we just talked about, things like Bitcoin and gold and hard assets that are more scarce. You've got those scarcer assets versus a money supply that could be going up dramatically, fiscal spending going up dramatically, increasing deficits. So
absolutely. Yeah. I mean, that's kind of the bull case for Bitcoin, right? Is, well, the government's going to inject all this QE and all this money and, keep rates super low. What does that mean for hard assets and something that, is really a better money than fiat currency, right? I'm a fan of both gold and Bitcoin. I know that's like really bad to say in some crypto circles, but
is it really?
Some people are very tribal. We've talked about that the past couple of weeks, right? Like, people love to fight on Twitter. When gold dipped a week or two ago, I said, guys, it's lame to like troll the gold bugs when gold pulls back, right? And then sure enough, gold's testing all-time highs, right? Like, you don't have to be a hater of one or the other. You can look at them both equally and say, like, Bitcoin is actually a better form of hard money because of all the properties, right? It's digital. You can send it around the world. Like, gold is kind of a pain in the ass. It really is. Like, every time I go to buy gold, I'm like, wow, like buying Bitcoin is way better than this. And like, as far as the moneyness property of being able to send money around, like, Bitcoin is so much better in certain ways, but gold does have a leg up because it's got thousands of years of history and it is a physical. So I like to have both. I don't know.
They both add value in their own way.
Yeah. So with that said, so we've got some strategies going into a recession, coming out of a recession. We've talked about a couple of scenarios of what this could look like, right? Like it could be a V bottom bounce, it could be a really deep, capital D word. It could be, a decade or more of just stagflation. What should we not do, guys? Let's talk about that. So some mistakes to avoid. Nikki, I know you talk to a lot of the guys in the stock trading room. What advice would you give somebody that's new to the markets, or maybe they've been in the markets for a long time and they just need to hear some kind of support around panicking?
Yeah, I think that a lot of people sometimes they just need to talk it through with somebody, because a lot of guys I end up talking with and and some ladies too. And at the end of it, they're like, yeah, I just needed to talk this out. So sometimes that's all it is seeing those degenerate red candles can get scary, and you're looking at the market and you're going, what the hell, you know? But like I said, pull it back. Let's look at what the market's done historically. Let's look at the data. Let's look at the actual hard numbers and get some possibilities and probabilities on the table and work around that, you know? And in the community, I've been trying to kind of tell people what I think the possibilities and probabilities are, and kind of map out, okay, we could see from this percentage sell off, you know, what's your plan, you know? Do you own any stocks that it would make you feel uncomfortable to take a further drawdown on? Well, if so, you should have thought about that before you got into the trade or into the investment. And that's why it's so important to have a plan, because I know for me, I'm seeing a drawdown in many of my positions, but these are quality companies that I would own at lower prices. I knew that going in, that I wanted to, you know, scale in and then add more. And as hard as it's been to be patient, I want to see what's going to happen with the market, obviously, and be patient as I can. But it's nice to have that ability mentally to know, okay, yes, I'm buying this quality company, or I'm buying the index, which I'm going to hold and have for a while. If it goes lower, I can see myself wanting more of this.
Yeah, it's all about time frame too, right? Like we talk a lot about the difference between passive and active investing. Passive stuff that we're not going to touch for decades, okay, go through the drawdowns, whatever. Active stuff, right? Timing is a little more important. Like you said, you got to know when to average down on a winner, right? Yeah. Not add to something that is a value trap that's over leveraged and has high bankruptcy potential. Yep. Or on the crypto side, shit coins that are probably going to die in the recession. That's actually a prediction, by the way. So I've been waiting for a bigger culling or like mass death of a lot of these really bad crypto projects. I think in an environment like this is where that could happen, right? We're going to see a few of the quality projects rise to the top, and the mass majority of them die off. And you know, we see that in the stock market, but I think because crypto hasn't been through a recession yet, this is where that is much more likely to happen.
Yeah. I agree with that.
It's definitely a good time to look at your portfolio and remind yourself of what you're in, how long you're going to stay in, and if this is a quality enough company to where you'd want to be in at lower prices.
Yeah.
Boom.
Step one, step two, step three.
That's really important, and understanding that we're in a different market environment, and so you may have to rethink what you previously thought might have been a well-positioned company. Like I made a mistake. I bought, there was one energy company that I bought too early. I was buying before the Saudi and OPEC stuff was announced, and because I thought the stock looked cheap, and the stock was down more than 50% this past week. Now I didn't add to that because at current oil prices, looks like they might be in trouble. So luckily I'd position sized it small enough to, it's not going to hurt me long term. And I'm adding to stuff that it's actually high quality at really, really good prices now, but I'm not going to add to that one that I already had a position in. I'm not going to let that become, I rethought that. You got sometimes.
So you had a thesis, you got in, you're like, okay, this is a decent value. Then it dropped and the picture changed where it's like, oh, actually at these prices, this thing can't survive. Yeah. So the probability of success goes way down. So instead of adding, you kind of accept that this could be a 100% complete loss, that's right. Whichever your portfolio, maybe a fraction of a percent or a percent or two.
Yeah.
Right.
And this also speaks to why we make sure that we're making sure that we don't oversize positions.
Yeah.
You know, this is where diversification becomes very important, to where you're not too, overexposed in one position.
Yeah.
We've spoken to that a lot.
Yeah, I got a message from someone the other day that said that they had like 90% of their portfolio in like micro mining stocks, and so or micro cap mining stocks, and I was like, yeah, you might be a little bit too overexposed. Probably not the environment to, even if gold prices do well, if those companies, those small junior miners often need capital, and this is an environment where capital can be a little bit scarce. Yeah. So you may not want to 80% in any one sector or 90% in any one sector usually is a red flag for me.
Yeah.
So yeah, so don't be, and you know, we came from a time period of this like slow, steady rise, right? This trend, beautiful trend that we had going on, and people were using leverage. People were buying tons of call options and put options. Again, we're in a different environment. You don't want to be using leverage during a time of really high volatility necessarily. So don't get too over leveraged with, you know, using, you know, outright margin leverage or options in a time period where these big moves are being made, because you can get taken out.
Both directions.
Yeah. Yeah. Good point. I mean,
Every day.
Yeah. That's what we saw in 2010 after the flash crash, followed by a few months of high volatility. Every time there's a shock response, it's really difficult to know where the low is. But one thing that I can predict is there's going to be several months of volatility after that shock.
Yep.
You know, so you don't know when it's going to come, but once you're in it, you're like, oh, okay, we're in high volatility. It's time to adjust sizes, kind of pull back a little bit.
Yep, absolutely.
Cool. Let's get into some Q&A.
Cool.
So these were some questions that actually came in during the live masterclass yesterday, but they're questions that we get so often that we just wanted to answer them again in this format on the show. So Daniel asked, what tools do you guys use to manage and track your portfolio over the long term when you have exposure to such a wide variety of assets like Bitcoin, gold, stocks, futures? I think that's a great question, right?
Yeah.
And I have kind of my machine with, you know, I'm in a dozen or more different assets. I know you guys are diversified as well. What do you guys use to just track the performance and what stuff is and where it is?
Excel.
Yeah, spreadsheets. Yeah, I wish, you know, I wish there was a better software tool that really did the job of pulling everything in. But even if it did, like is some stuff like what is it, Personal Capital and Mint.
Yeah,
and stuff
but
like
it's
that.
still too complex to get
Yeah.
returns and
Yeah.
get your position sizes and everything all.
So there's no perfect solution. That's a good idea for any SaaS
Hey,
developers.
yes,
Yeah.
somebody, please.
Yeah, but a lot of what I do just ends up, you know, I do able to like download and import stuff quickly, but then I got to do some manual manipulation in the spreadsheets.
Yeah. Same with me. I mean, on the crypto side, it's even more complex because I've got accounts with so many different exchanges.
Yeah.
And I've also got different capital buckets where over here I've got my accumulation plays. Here I've got my midterm swing trades. Over here I've got my basically like venture capital crypto bucket. Like it is a challenge to track it all, but I'm old school as well. Excel spreadsheets or just a freaking paper document where I kind of track where things are and run the numbers and
It's all in here.
yeah. So I guess the answer to Daniel's question is there is no single best tool, but if you have like one stock account, that's pretty easy because you can just download the trade records and get your performance data from there.
Yeah.
What you could also do is I think in Personal Capital or Mint.com, you can add in manually different assets.
Yeah.
Like if you
Like other property.
Yeah, like if you have gold or crypto, that things you can't log into to pull your balances.
Yeah.
You can do that, I believe. And then you'll at least be able to track your net worth through those applications.
Yeah.
But you won't necessarily be able to know how your portfolio did on a weighted basis. You'd have to manually calculate that out. But
Gotcha.
Yep.
Cool. Tony asks, I don't want to panic sell, but you mentioned taking some money out. What percentage would you scale out of tech stocks right now? So we kind of talked about this. Travis, I'll kick this one to you first since you are the tech guy.
Yeah.
What do you think?
Well, yeah, and I'll just say right up front, like it's hard to know exactly what advice to give here because I don't know necessarily like what percentage of your portfolio is currently in tech stocks. And, you know, if you need capital going forward or, you know, what kind of percentage of cash allocation you have in your portfolio. So I would want to know all those things before I could really make a good decision. But generally, if you're like heavily overweighted in tech stocks, especially if you're in the ones that are still trading at very high, you know, 10 to 15 times enterprise value to sales type of valuation multiples, might make sense to take some of that off the table. It would make me nervous to have, let's say, you know, more than 50% of my portfolio in very highly valued tech stocks. So, and again, I think there's some really interesting bargains starting to emerge in some of these other sectors that have been harder hit during the sell-off. So, yeah, I think it might make sense, but again, it really depends on what that level is for you already.
Yeah, and it's hard to give like a complete picture here on a show, but I think the idea is just to know if you do have a lot of tech stocks, what are you in and why, and think about the downside. Well, how low could this go, right? Like if prices collapsed 50, 60%, what would that mean for the valuation? And if you don't know how to calculate, take Travis's course, because he knows how to do all these models.
Yeah.
Harry asks, what trading platform do you guys work with? Like TradingView, Coinigy, stuff like that. I'll answer this just to start. I really like Coinigy and TradingView as far as charting platforms go. With my crypto trading, I just trade directly through the exchange websites. I don't really trust the APIs. And, the more complexity you add to your trading routine, the more room there is for error. So I just, use charts like TradingView, Coinigy. They're both very cheap options. I know, like on the stock side, Nikki, you can use, what do you use?
Interactive Brokers, TradeStation, any of those that are basically you're directly connected to the exchange.
Through your broker.
Yeah. And there's, for stocks, any of the major guys, TD Ameritrade, Charles Schwab, Fidelity, they also have platforms and web trading.
Yeah. Any others, Trav? What do you prefer?
Yeah, no, I use all those tools that you guys just talked about, that you, Nikki, talked about, like TradingView for charting and alerts and watch lists and things like that. Also use stuff like Seeking Alpha to get like news alerts on stocks, or Koifin to look up financial stuff. But I have a whole video on tools I use on my YouTube channel. But
we'll link that up in the show notes.
But yeah, I think the ones we've talked about so far are a pretty good start.
Awesome. Yeah. So so far I think we've covered a lot of ground. One last question. Taylor asks, where can you find private stock prices? So that's actually a question I've gotten surprisingly a lot. Because a lot of people are interested in private markets.
Yeah.
And they don't really know how to invest in private companies.
Yeah, that's a tough market. It's very opaque. There are a couple websites like Shares Post or Equities In, where they actually have a platform for trying to match up sellers of private company stock with accredited investors who can actually buy that. It typically can only happen with like a company that's relatively later stage. So think like an Airbnb, or a company that's about to go public probably in the next couple of years.
Yeah.
The hard part about all this is the sellers of these private company stocks have more information than you do. There's the valuations are typically pretty high because it's on successful companies that have been raising venture capital at high valuations. So it can be kind of tough and even risky to buy private company stock on some of these platforms. And sometimes there's just not even any volume there. So you can't just like go buy any private company stock you want.
Yeah. At this point in time, it's really like an OTC market where, like you said, you're matching a buyer and a seller.
Yeah.
And I think that's what these tokenized platforms, like T0 and stuff like that are going to do, is offer an actual central exchange where you can trade private companies through tokenization.
Yeah.
So I'm excited for that. That's just a really slow moving space.
Yeah.
Like, it's not happening overnight. It's taking quite a while, but
well, with the IPO trend, you could just wait for it to IPO and then it'll tank like all the other ones are, and you can probably pay less.
Yeah. So that's it. Don't buy IPOs. Just wait for the initial
it's
crash.
a joke. Not really. There has been that trend, but
Cool. Well, good stuff so far, guys. Looking forward to what happens over the next few days and weeks. Obviously, I feel like the markets are hinging mostly on the virus right now. Yeah. People are saying, well, it's not the virus, it's this. I'm sticking with, no, the virus is having a big effect on global economy. I mean,
everything.
Sure.
Just look at the pictures of recent video of the most popular tourist sites. They're empty right now for a good reason, right?
Eerie.
A lot of flights are empty. That it's affecting companies directly.
Yeah.
So that's going to affect the economy directly. I don't know. Any final sign-off thoughts?
Well, yeah, I definitely recommend if you want to hear more about how our investing strategies around this type of environment. We did that webinar, like you said, that we've kind of recapped today, but we had a longer runtime yesterday, and I think we even mentioned specifically a few more like actual stocks or sectors that we're looking at. So definitely check that out if you're interested in more of that.
Yeah, we can link that up in the show notes as well.
Yeah. As far as the environment goes, I think like you nailed it. We're going to be in this environment for at least a couple months longer, maybe even longer than that if, the global economy itself is, kind of more permanently affected. So, we've got to buckle up and just try to make smart decisions and be rational and,
Yep.
Hopefully come out this, stronger on the other side. Like one of my favorite investing quotes, I'm not actually even sure who to attribute it to, but when I heard it, I was like, oh, that's amazing. It's not what you own going into a recession that matters so much as what you own coming out of the recession.
Man, that's really powerful. Like, yeah, because as we were talking about, like the recession wasn't really over in '09 until the market had actually doubled from the bottom.
Yeah.
So like if you waited for things to look all peachy, you would have given up potentially up to a double in the broad markets. But like you guys saw at the fund, like you probably way outperformed double on some of those plays.
Yeah, I mean, some of the stocks that we bought in late '08, early '09 were up 3, 4, 5x within like 6 to 12 months. So
Nice.
yeah, if you waited for everything to look peachy, like you said, you could have missed some incredible bargains.
Nice. Well, hopefully you guys got some value out of this. Look forward to seeing you next week. Stay safe, and we will see you guys soon. Wash your hands. Social distancing. Stay away. Later, guys.
Take care.